Okay, let's jump right into this explainer and demystify one of the absolute highest stakes decisions you can make: choosing a business structure. If you're launching a new venture, or honestly, even if you're just kind of fascinated by how the biggest companies in the world operate, you are definitely in the right place. We're going to break down the crucial split between legal entities and tax entities, or what I like to call wearing the two hats.
Because really, it all boils down to this. How do you protect your savings and lower your taxes when starting a business? Honestly, this is probably the most expensive question a new founder can ask. Making the wrong choice here, it can trap your money, hit you with double taxation, or even worse, leave you personally liable if things go sideways.
So to get through the weeds today, we've got a clear roadmap. We'll start with the entrepreneur's dilemma, look at legal shields, uncover the tax form secret, run through how income gets taxed, tackle owner pay and business losses, and finally look at choosing the right entity. Let's get going.
Starting with Section 1, the entrepreneur's dilemma. Meet Nicole. Let's ground all these abstract concepts in the real world with a quick story. Meet Nicole. Right now, she's a state government employee in Utah, but she's got a brilliant idea. She wants to manufacture uniquely patterned, temperature-regulating bed sheets. She's calling her startup Color Comfort Sheets. And while she's getting rave reviews for her prototypes, Nicole is smart. She knows that starting a manufacturing business is a super risky path. So before she makes a single move, she has to figure out how to legally and financially structure this whole enterprise.
That brings us to Section 2, legal shields and structures, or putting on the legal hat. Our absolutely crucial first step is figuring out how Nicole can build a fortress around her personal assets.
Now here is where things get really interesting, because there is a massive misconception out there. People tend to think your legal form and your tax form are the exact same thing. They are absolutely not. Your legal classification happens at the state level. That's what determines your liability and your legal rights. But your tax classification? That happens at the IRS level, and it strictly dictates how your income and losses are taxed.
So, if we break down the legal options available, you can see exactly why Nicole makes her first big move. With a general partnership or a sole proprietorship, the owner is literally on the hook. If the business gets sued, her personal savings are totally exposed. Since she's diving into a potentially risky manufacturing venture, she quickly narrows her choices down to either a corporation or an LLC. Why? Because those are the only ones that completely shield her personal assets. Now sure, if she wants to go public one day with an IPO, she'd need a corporation, but for right now, the LLC gives her incredible flexibility.
Moving to Section 3, the tax form secret, or putting on the tax hat. She's formed her LLC, her legal shield is up, but now she has to take that legal hat off, put on her tax hat, and deal with the IRS.
Before we look at her exact options, we need to nail down this one vital definition. A flow-through entity is a business that doesn't actually pay taxes on its own income. Instead, that money flows through the business directly to the owners, and they pay the tax on their personal returns. Guys, this is the secret weapon for so many small businesses because it completely avoids the dreaded corporate double taxation.
And this whole concept of check-the-box regulations perfectly shows how the IRS handles this. If Nicole legally forms an LLC and she's the only owner, the IRS automatically says, okay, default sole proprietorship for taxes. But, and this is a huge but, she has the power to literally just check a box on a form and elect to be taxed as a C corporation instead. And from there, she could even elect to be an S corp. An LLC is essentially a legal chameleon. It can be taxed as almost anything.
Section 4. How income gets taxed. The math behind the decision. Let's actually look at the numbers and see how this impacts Nicole's bottom line.
Okay, if she decides to be treated as a traditional C Corp, her income gets hit with that double taxation we just mentioned. Step 1, the corporation itself pays a flat 21% tax on whatever profits it makes. Step 2, the money left over gets distributed to Nicole as a dividend. And Step 3, Nicole pays personal tax on that dividend, which can be up to 23.8% if she's a high earner. So the money is literally taxed twice before it ever hits her wallet.
On the flip side, if she goes with a flow-through entity, like an S-corp or a partnership, she dodges that double taxation entirely. The business pays zero income tax, but the income flows through to her, pulling her into a pretty complex web of individual taxes. She's got her personal tax rate, which can climb up to 37%. She might get hit with the 15.3% self-employment tax, or maybe a 3.8% net investment income tax. But then again, she might also qualify for the qualified business income deduction, which is huge. It lets you deduct up to 20% of your business income right off the top.
So what does that actually look like in practice? Let's do a quick what-if scenario.
Let's assume Color Comfort Sheets makes a $500,000 profit. If Nicole takes advantage of that QBI deduction and operates as an S-corp to avoid self-employment tax on her profit allocations, she could potentially drag her overall effective tax rate down to just 29.6%. That is a massive amount of savings compared to the heavy double taxation hit of a C-corp.
Section 5. Owner pay and business losses. What if things go wrong? We've been talking about profits, but how does she actually write herself a paycheck? And honestly, what happens if the startup just bleeds money in year one?
Getting paid is a huge factor here. As an S-corp owner, the IRS forces Nicole to pay herself a reasonable W-2 salary, and that salary gets hit with 15.3% in FICA payroll taxes. Now, S-corp owners obviously love to keep that salary as low as legally possible, so the rest of the profit flows through without that 15.3% haircut. But listen, you have to be careful, because the IRS will aggressively penalize you if they catch you artificially lowering your salary just to dodge those taxes. Partnerships, on the other hand, pay out guaranteed payments, and those are entirely subject to self-employment tax.
But Nicole is a realist, right? She fully expects it's going to take a couple of years before Color Comfort Sheets sees a dime of profit. So how she handles early losses is a massive deciding factor.
And this is where the flow-through entity is just an absolute lifesaver for startups. If she formed a C-corp and lost, say, $50,000 in her first year, that loss is completely trapped inside the corporation. She gets zero current tax benefit from it. But if she uses a flow-through entity, like an S-corp, that 50 grand loss flows right through to her personal tax return. So if she's married and her spouse has a high-paying job, her startup's loss actually offsets her spouse's income, which lowers their total joint tax bill for the year. That's a huge strategic advantage.
Section 6. Choosing the right entity. Looking at the real-world scale. Let's pull back from Nicole's spreadsheet for a second and see how these tax strategies actually play out across the entire U.S. economy.
You know, given how much they're in the news, you'd probably assume C-corps basically run the world. But in reality, over 70% of all businesses in the U.S. are actually operating as simple sole proprietorships. It's just the easiest default. There's basically no paperwork to get started, so everybody uses it. Only a tiny 5% of businesses operate as traditional C-corps.
But flip the metric over to the actual money being made, and the story totally flips with it. That tiny 5% sliver of C-corps, they generate a staggering 60% of all business receipts in the entire country. Meanwhile, that massive 72% chunk of sole proprietorships brings in a measly 4%. It just brilliantly proves the point. When you scale up, when you're raising millions in venture capital or gearing up for an IPO, the C-corp structure is absolutely the go-to for the heavy hitters. Which really brings us to the ultimate takeaway from all this. Whether you're Nicole launching a bedsheet company out of Utah, or you're a massive private equity firm managing billions in global investments, there is literally no single correct answer here. You're constantly having to balance your need for a tough legal shield with your appetite for tax flexibility and deductions.
It's just a complex puzzle, and the financial stakes are massive. So I'm going to leave you with this. If you were launching your dream business tomorrow, which structure would you choose? And which hat would be keeping you up at night? Making sure you're legally protected, or making sure you aren't paying double to the IRS? Thanks for hanging out with me for this explainer, and I'll catch you in the next one.